We are going to head into our next session, which is on the future of innovation, plenary perspectives from the Mountain West and lessons for the National Commission on Innovation and Competitiveness Frontiers. There are going to be 4 back-to-back sessions here, about 20 minutes to half an hour each, touching on the topics of the future of finance, the future of energy, the future of place-based innovation, and the future of partnerships between industry, academia, the national labs, and other critical stakeholders. So we're going to get started first with the future of finance, and let me invite Steve and Ali to join me up here on stage, and we're going to switch over to the chairs. So the world of finance is being swept up in a whirlwind of change, as we've talked a lot about over the last day and a half. New technologies, new business models. The pandemic has fueled a lot of these changes as businesses and consumers have migrated to contactless and online shopping, a reliance on digital finance systems. A couple of examples: fintech firms have opened a revolution in finance, challenging big banks, blurring industry lines. Big data has joined money as the finance industry's lifeblood. Blockchain, cryptocurrency, new AI-enabled robo-financial advisors are on the way. We're seeing decentralized, direct-to-consumer finance, digital ID, new players in the venture capital world. And as we heard yesterday, even the federal government is getting into the role of big investor with billions of dollars of proposed investments in energy, semiconductors, et cetera. And as all this is happening, regulators are trying to get their handle on how to manage these rapid and game-changing developments. So joining me up on stage here, I have 2 wonderful speakers who are at the cutting edge of technologies and models that are reshaping the world of finance. Professor Steve Lupien, who is the director of the University of Wyoming Center for Blockchain and Digital Innovation. Dr. Ali Nejadmalayeri, who is the John A. Guthrie Endowed Chair of Banking and Financial Services. But before we get to them, we have a special video from Senator Cynthia Lummis, which is entitled U.S. Competitiveness in the Financial Innovation Space. So we're going to start with that, if we can tee that up.
Hi, I'm Cynthia Lummis, happy to be with you today to talk about U.S. competitiveness in the financial innovation space. We are still the global leader in the finance sector, but digital assets are here to stay, and we need to work with them. The technology creates opportunities in nearly every sector of the economy, making payments faster and smoother and cheaper. So Senator Kirsten Gillibrand of New York and I have crafted a framework for digital asset innovation, relying on 21st century regulation as well as 21st century technology. We had 3 common goals in mind when developing this legislation. We want to provide clarity to both industry and regulators so individuals and businesses know what rules they have to follow and regulators know what rules they're enforcing. We want to provide guidance through legislation in key areas including cybersecurity standards, consumer protection, securities disclosure, standard definitions, stablecoin, and banking. We want to incorporate flexibility, which is still in its infancy for digital markets. So this has been a tough task, but we've been working with stakeholders for months to make sure our legislation promotes innovation and protects consumers. The surest way to stifle an industry is to dump excessive regulations on them early. More mature institutions can pivot and adhere to heavier regulation, but small emerging institutions cannot. So Senator Gillibrand and I have worked carefully to make sure that this new innovative industry has the space to grow. We're still getting feedback on this legislation. We'll probably see it reintroduced at the beginning of next year and move forward legislatively then. It's possible that a couple of areas could be pulled out for consideration this year, including the parts dealing with our commodity regulators, as well as the part dealing with stablecoins. You are all working on the front lines of some of the most innovative sectors in our economy. You can see what the next big thing is better than we can in Congress, and rely on your input and expertise. I hope to hear more from you as we continue to fine-tune this legislation. Thanks for allowing me a few minutes to update you on what we're doing in Washington. Enjoy your conference.
Okay, with that as an introduction, the floor is yours, Steve.
Okay, well, again, I'm Steve Lupien. I'm the director of the Center for Blockchain and Digital Innovation here at the University of Wyoming. We've got a pretty innovative program here. We are one of the first, in fact, the first Division I university to offer a degree in blockchain. We're the first Division I university to have an educational mining operation and a pretty sizable staking pool operation as well too. So a lot of interesting things happening here. But what I really wanted to talk about was, where did we get to where we are today in this space? And I very quickly want to just remind everybody where we've kind of gone from the original Web 1.0 of the mid 90s, where it was really just about information. It was about, you could look up almost electronic brochure on companies in Web 1.0, but it didn't take long for us to innovate and move on to Web 2.0. Well, now we are starting to get transactions. Who here hasn't, bought something on Amazon? That's where we kind of are right now, and that's being driven right now by intermediaries. When you buy something from Amazon, what do you use? You use your credit card, which is tied to your bank account. So there's an intermediary involved. Well, where we're going to next is the Web 3.0 environment. I know you've all heard that term quite a bit, but what does that really mean? What it really means is the internet itself is going to be able to move value without intermediaries. You won't need necessarily the bank accounts in the same way you are using them today. You're going to start seeing a lot more functionality in smart contracts. These are automatic if-then statements that run on the internet and conduct business fully in an automated way, including moving value. And the other thing you're going to start seeing in this Web 3.0 environment is much more peer-to-peer finance. And we'll talk a little bit about that in the next slide. So what does, I'm going to confine my remarks, since we have a short period of time, to just the financial aspects of what's happening with digital assets. I'm not going to go into NFTs and things like that, because they're kind of outside of the scope of what we're talking today, but they're related. But in the Web 3.0 world, you're going to see impact, financial services impacted in a number of different ways. First of all, of course, what kind of started it all is digital currency, and how digital currency is going to be used on a day-to-day basis is going to continue to change. Next, and you heard the senator talk a bit about this, is payment systems. Payment systems are one of the fastest growing segments of digital assets right now. You heard the senator mention stable coins quite a bit in her video. That's really where these are going to reside. The way that we are going to transact in our everyday business lives is going to change pretty substantially in the next couple of years. Another big topic that I know my colleague here speaks quite a bit about is the role of government in the digital asset space. You'll hear the term CBDC, which is central bank digital currency. And there's a lot of talk going on about both the positives and negatives of CBDCs. I happen to be a pretty strong proponent of wholesale CBDCs. I'd like to see our financial institutions and our banks work with our central banks using a digital currency, but I'm a little reluctant to take it to a retail CBDC where each one of us are using a digital currency. We can see how that's playing out in places like China right now. And I don't know if here in the United States, we really are ready to have that level of government involvement in our everyday transactions. But we're going to be hearing a lot about that in the next couple of years. There's a bill being introduced by Senator Toomey that's going to address this quite a bit. So it definitely should be on everybody's radar screen. What's not being talked a lot right now, but is very much going to be impacting our lives, is how the metaverse and the economies that are going to develop in the metaverse are going to evolve. In my opinion, the first two areas that are going to be disrupted by the metaverse is entertainment, and the next is going to be education, which is important to a good number of us here in the room. And there's going to be entire economies built around that because people will be working and living and playing inside of these metaverse ecospheres. And digital assets are going to be the store of value and the unit of value within these metaverses. So we have to think and make sure that we drive that innovation in a way that's positive. And then the last area where I think we're going to see some big financial changes is in the DeFi market. And the DeFi market is really a new emerging way that we're going to be interacting with both banking and with the way we are interacting within the digital asset space. So from a 30,000-foot view, as I look at where we're going in finance, these are the areas where I think we're going to see some real change happening pretty quickly. Now, I wanted to talk a little bit because we're seeing what's happening right now in not only the U.S. economy, but also what we're hearing as the new crypto winter. I probably heard that phrase more times in the last 2 weeks than I have any other time. And so I think there's lessons to be learned from what's happening right now. And because one, I think it should be addressed by policymakers. And number two, I think our industry has some fault as well too. First of all, I think here in the US, our regulators' inaction has created a lot of the challenges that we have today. And what do I mean by that? Well, we really don't have clear regulatory guardrails around this space yet. And with the lack of those guardrails, two things happen. One is bad actors are allowed to come in and offer products that really don't have any consumer assurance that they're real. And we're starting to see that. You may have heard about things like the failure of Celsius and BlockFi was recently bailed out. Well, these were crypto lending companies that essentially operate in a non-regulated environment. And I think there's a problem there. And the other problem with that, with government inaction, is it's kept out the good actors. Okay, you need a strong an appropriate regulatory framework for the good actors to come in. So I think there's some lessons to be learned there for policymakers. I think there's some lessons to be learned from us as consumers as well too. That environment has allowed opportunists to come in and take advantage of those systems and create a lot of the volatility that we're seeing today. When you look at something like Bitcoin and you say, well, look at the volatility that's happening in Bitcoin. Well, interestingly, when you actually look at the built-in inflation rate to something like Bitcoin, Bitcoin only grows at 1.75%. In fact, it's probably the hardest money that exists today, but we're still seeing a lot of volatility in that price. Well, a lot of that has come about because of the lack of regulation. What's happened is financialization of a product that was designed not to be financialized. The original vision of Satoshi Nakamoto, whoever he, she, or they were, was to have a asset that was free of all of this financialization and games playing that happens in the banking industry today. But without appropriate regulation, we allowed that to happen. And why does that create problems? Well, first of all, leverage, which is the basis of our banking system today. Allie and I have debates about this all the time here at the university. Leverage in digital assets is a bad thing. They don't mix. Why? We have different settlement times, okay? Leverage often, trades in days where digital assets trade in minutes, if not instantaneously. And unlike the banking industry that has the FDIC and the Federal Reserve behind it, digital assets have no lender of last resort. So when there is a leverage flush, which is what's really driving the price today, and the challenges we've seen in the last couple of weeks, there is no one to bail digital assets out. So that's where you get the problems we're in. Before I hand it over to my colleague, one of the things we have been talking about in this conference that I think is important to highlight is place-based innovation. And both Deborah and Tony, our keynote speaker this morning, talked about that. So I want to take an opportunity to talk about what we've done here in Wyoming around this space. And so since 2016, we've passed 30 bills enabling digital assets. And Wyoming has truly led the way. And I hope we become that place-based center for this industry. A couple of the things that we've done that are I think unique and special, and I hope policymakers take note of this, is Wyoming is the first state to actually define digital assets under the law. No other state has done that. Now, there is a Token Taxonomy Act going through Congress right now. It's HR 1628. It's essentially Wyoming's definition federalized. We're the first state to map digital assets to UCC law. I think that's important because businesses need legal certainty in order for them to operate. They're not going to be able to bring in investment in, without having clarity for their investors of how their company will be treated under the law. We've created a fintech sandbox. These are all new and unique products that we don't know how they're going to fit within legislative structures. So let's create an environment where these innovations can flourish in a safe way that's being regulated. Okay, we're making sure that no mom and pop are not being taken advantage of, but let's let the innovation flourish, and Wyoming has created that environment. Probably the most important thing we've done is Wyoming has created the first new type of financial services industry in the US in the last 50 years. They're called special purpose depository institutions, and they're 100% reserve banks that are allowed to custody digital assets. Why is that important? Well, under US law, certain investors need third-party custodians in order to invest in certain categories. And if you don't have qualified custodians, you can't invest in that asset class. So foundations, family offices, some others, without a legal framework, and a regulated entity. By the way, Wyoming SPDIs are regulated by the Wyoming Division of Banking. We have 4 in Wyoming right now. 2 of them are actually working their way through the Federal Reserve to get master accounts. So I think that's the type of appropriate regulation that the federal government should look at. And I think states like Wyoming are exactly where this innovation should happen. So with that, I'd like to turn it over to my colleague.
Thank you, Steve. Trying to find the slides.
Teeing it up for you here.
All right. Good afternoon. Thank you for everyone being here. Thank you, COC and President Seidel, for bringing the event here. It's been illuminating. Met a great number of great people, very educational. So thank you all for that. I'm going to be taking a little bit different sort of a perspective on this. As the title said, I'm the banking guy. For 25 years, I've studied corporate bonds, municipal bonds, mortgage bonds. So unlike my friend, I'm in love with leverage. Now, finance and future. It's an intertwined history. The very first concept we teach kids is present value, future value. And it's not by happenstance. On the eve of Waterloo battle, something fundamental happened in history. Brits, who were funded everything by fictitious money, consul bonds, forever bonds, won a war against powers that were funded by silver and gold, mostly coming from other places in the world. They proved one important thing. When you make a contract with yourself through the only time machine in existence, debt, you look into yourself 100 years from now, all powerful, wealthy, and everything, and you ask one question, dude, spot me a buck or you never be. That machinery has been so powerful that instigated the rich British banking legacies, the Rothschilds, Barclays, funded the steam engine revolution, and then came to this country, created the American dynasties, Morgans, and etc. Peabody and Morgan went to Britain to replicate the model for the new colony, to fund municipalities first, and then corporate bonds. Basically, they funded the American Industrial Revolution. When it came for the 20th century, the bankers realized most of the upside is going to the entrepreneurs. Why can't we get a share of the action? And hence you have the VC revolution. Everything you're familiar and in love with is because of this. We stand in front of a future, look through that future, and then try to figure out how can we help that future come to fruition. So what are the potential futures? And this is my humble opinion, obviously. Blockchains. Since Steve has talked about this at length, I'm going to be short about this. They have revolutionized payments, back office operations, bring in privacy and access at the same time. But at its core, what it does is what debt does at that point in time. If we are going to move away from representative democracies to distributed, decentralized democracies, this is the way to do it, and no other way that we know of. We live in the idea economy. We stop building big stuff, we do big ideas. That's fantastic. The devil is everything is intangible. And if you ask any banker, the moment you want to fund an intangible asset, nothing's going to happen. There ought to be a collateral. So how do we rework everything for this to happen? Now, not that there is no model. Obviously, VC is one model. Movies gets funded all the time. So there have been experimentation. We have to basically bring it to the largest scale. We are being drowned by data. We generate them, and we don't even know what to do with them. So much so that now they're in the clouds. They can't even reside down here. So data science has been revolutionized. Qualitative analysis, AI, ML, all of that. But it comes back to, as Steve said, if we're about to transact and exchange our data, which also means on the backside of it, there is a financial transaction that is also happening. What kind of transaction? What kind of conduit? What kind of machinery has to finance that exchange? Greatest challenge of our time is sustainability. We are thinking and talking about alternative energy, smart connectivity, urban planning, et cetera, et cetera. All of that affects not only corporate funding, but also municipal funding, city fundings, et cetera, et cetera. That demands a new type of financing, new type of conduit, design of new contracts, definition of new rights, how these rights can be transacted, exchanged, et cetera. And lastly, at the precipice of the greatest revolution, biohealth. If you think about it, we just went through a pandemic that could have lasted more than 2 years, but it all wrapped up because of innovations in biotech. How do we pay for this? How these rights are defined? Imagine that I can do a DNA analysis on my own and find out that there are diseases that 10 years from now I'll be facing. Should I be shunned away from the insurance industry or not? Should we integrate the insurance with biotech development or whatever other innovation you can think of? And lastly, the aging population of the advanced world. Projects that I'm working on right now has to do with reverse mortgages. At the end of life, there's a Persian saying, it would be absolute misery to be old and to be poor. So how do we help people in their old age to pay for all this stuff they need in order to have quality of life? I'm going to close by an example, something that I've dabbled with here and there about it. And I'm going to call it digital jump upon Morgan. In his day, JP Morgan would shake your hand and you would get money. If he would not shake your hand, good luck. It was about character of a man. There was no book, there were no numbers or nothing. He would just sit down, look at you, 2 minutes flat, he would know whether he wants to go in bed with you or not. We developed and invented business models, accounting systems, SEC, et cetera, et cetera. Move away from that world, and now you want to apply to a loan, even a simple car loan, you have to basically put a ton of paperwork that proves this, that, and the other in order to get your money. It's not just about loans, even VCs, even equity, et cetera, et cetera. But we have moved away from that. In the last decade or so, we have developed textual information. Companies used to do maybe a page of CEO report. Now it's a Tolstoy novel. And they have learned this thing that if I dump 2 tons of information, no one's going to find anything. So we have to deal with that. We have social media. People do all kinds of crazy stuff. There are some unsavory characters. Look at your Facebook activity, decide whether they want to do financial transaction with you or not. And all of that is because it reflects you as who you are. So here we are at the age of a digital JP. Everything that we designed through legalese, intangible assets, ideation, et cetera, all the old models of writing financial contracts is basically obsolete, have been obsolete for a long time, actually. Now we have to basically look through alternative data. We have to look through alternative means to basically form the thing that JPM did at his day, whether you have the character to be a good partner in a financial transaction. And the devil is, how am I going to go doing that? Thank you.
Thank you both for that for those comments. We just have a couple minutes, so maybe we can just do one, possibly 2 very short questions. Deborah, up here at front.
Well, the Chinese have moved their entire economy online, essentially with a digital yuan. And there are certain advantages to that, but there's also some real challenges. The Chinese government can see every transaction their residents make. They use that for surveillance. They can identify who is protesting in Hong Kong by who bought a sandwich nearby. And so there's a lot of challenges like that. Also, I want you to think about the power of a government being able to cancel your wealth. And not to pick on our friends up north, but we recall when the truck driving protests in Canada came about and the government had called for banks to seize some of those assets. Imagine if the government can simply cancel and delete the digital assets that are in your bank account. So there are dangers to this that policymakers here in the United States are definitely going to have to focus on. And I know Senator Lummis is quite involved in that for that very reason. That is a policy decision. So I'm a firm believer in digital assets, but I also recognize there's some dangers to it as well.
Ali, did you want to comment on that?
I think that was a perfect thing to say. The thing about the sort of a distributed ledgers, if you will, is that it diffuse information. So it can be used for good or bad. When it's available for surveillance, it can be used for all nefarious activities. At the same time, if we put safeguards around it, then it allows a much more effective democratic consensus building sort of a framework.
Great. One more in the back.
Yep. Steve, on your last slide, you had incorporations via DAOs, and those of us that don't live in your world might not know what a DAO is.
Distributed autonomous organizations. Wyoming is leading the way in this entirely new type of business incorporation, which brings the distributed nature of the technology to the way businesses operate. Businesses tend to be, especially in the way you register them, very hierarchical. Who's the president? Who's the vice president? Who is your secretary? And that exists because Secretary of States essentially want to know if something goes wrong, who do we arrest? Well, there's new forms of corporate structures are developing today where there is no hierarchy, where essentially it's a pure democratization of the way the company runs. Probably the best example of that, and I'll be brief, is anybody follow Constitution DAO when it came out? One of only two US constitutions in private hands became commercially available about 3 or 4 months ago. And a DAO was created to raise funds to purchase this privately owned constitution. That organization raised about $45 million. Unfortunately, it wasn't enough, and the Constitution sold for more of that. But what was unique about that organization was everyone who contributed then got a vote. If we won the Constitution, where would it go? Good news was it would have gone to the University of Wyoming, but we didn't win it. So it's DAOs are going to be a unique way that businesses are going to be able to organize around that structure, and Wyoming's leading the way.
So if I could have a follow-on question
Sure.
to that, I was just at the International Economic Development Council's Future Forum down in Texas, and this conversation came up with the U.S. Patent and Trade Office, and the director was there speaking, and she specifically mentioned that this incorporation capability now for this DAO, how would they, if this entity could file for a patent, right? How would that work, right? Whose intellectual property was it? And so there's something lying out there, and she really didn't finish that statement, but she specifically mentioned Wyoming. And so I spoke with her later, and she's like, we're just trying to figure out how to build something around that, because they know it's going to happen, right? So have you any thoughts on that?
I'm not an attorney, but I'd love to talk to you offline about some of my comments. So I don't want our segment to run too far over.
Yeah, and we are at the end of our segment. So please join me in thanking our speakers.